We now move on to question 4a, which is from the chapter Partnership Accounts, and it carries 10 marks. To be specific, it is on the basis of the retirement of a partner. Now, if you look at this particular question, they have given us the profit sharing ratio amongst Amal, Bimal and Kamal in the ratio 3:2:1. Another important point is that they have given us the balance sheet as on 31st of March 24. When I look at the additional information that is given, I note that Amal, one of the partners, who is having a share of 3 parts out of 6, is suffering from ill health and wants to retire. And going beyond that, they say an agreement was entered on 31st of March 24 for taking up this process of retirement. When we look at additional information 1, they have given us that the profit and loss account for the year ended 31st March 24 showed a net profit of 1,50,000. Listen again. They are saying that the profit for the year ended 31st March 24 showed a net profit of rupees 1,50,000. And they tell us that this particular profit will have to be rectified for what purpose? Because Bimal, one of the partners, is to be credited with rupees 30,000 as bonus in consideration of the extra work that he has done during the year. But our balance sheet was prepared on 31st of March 24. It means that this 1,50,000 which was there was distributed amongst the partners in the ratio 3:2:1 without considering bonus. So we will require to make an adjustment for this profits which were distributed, adjust the bonus for it, and then find out what exactly is the profits that the partners will receive. When we go beyond, we find that with effect from 1st April 23, the partners are to share profits equally. Here they told us that the profits were 3:2:1. It means 1,50,000 was distributed in the ratio 3:2:1. But bonus of Bimal was not considered. We would have to consider that. And after considering that, we would have to readjust the profits in the new profit sharing ratio, which is to be effective from 1st April 23 equally. So you will have to prepare a profit and loss adjustment to show this particular effect. Now when we move on to the second adjustment, that is related to goodwill. The goodwill calculations will have to be made. They are saying that you are supposed to take 4 years profits. You will remove the average and multiply it by how many years? 3 years purchase. So you take the profits of the 4 years, remove the average, and then multiply it by 3. We will get the goodwill of the firm. But who's the partner who's retiring? Amal is the partner who's retiring. Therefore, we will have to find out what is Amal's share of goodwill. And now, students will get confused because they had given the ratio 3:2:1. But what was the ratio? Then changed to equally 1:1:1. Therefore, share of Amal in the goodwill of the firm will be 1/3. Then they have given us how the assets and liabilities are being revalued on the retirement of this partner. Furniture is being revalued at 1 lakh. Value of furniture was 1,25,000. It's being revalued at 1 lakh. It means there is a revaluation loss of 25,000. Building was to be appreciated by 10%. Building stands at 3 lakhs. Now the new value of the building will be 3,30,000. So there is an appreciation of 30,000. So revaluation profit. Inventories were to be written down by 25,000. Written down means it's a loss. So inventories will reduce. So revaluation on the debit side, that is inventories written off. And then you are supposed to make a provision of 2.5% on the doubtful debts. You are having your doubtful debts, that is trade receivables, that your trade receivables, on that you will be calculating 2.5%. And the remaining assets will be at their book value. They say after that, Bimal and Kamal, the remaining two partners, will continue this business and share their profits and losses in the ratio 3:2. And whatever amount is due to the retiring partner Amal will be transferred to Amal's loan account. Now let's look at the solution. Now when we are looking at the solution, the question tells us that we are required to prepare the revaluation account and partners' capital accounts. Mind you, they are telling us we are required to prepare revaluation account and partners' capital accounts. But as you can see, it is for your understanding that this profit and loss adjustment account and the balance sheet and the working of the goodwill have also been prepared. And if you were to ask me, yes, do prepare it, because sometimes the questions can also ask you to prepare the needful. Therefore, look at it. Now, as I said, profits, before they could change the profit sharing ratio to 1:1:1, the profits had worked out to 1,50,000, which were distributed amongst the partners. Therefore, now we are making the correction for the same, which was wrongly distributed in the ratio 3:2:1. Therefore, profit and loss adjustment gets a credit, and the partners' accounts get a debit for it, because they were credited with the ratio 3:2:1, that is 75, 50, 25. That is, we are nullifying the wrong entry made by them. Now we are correcting it. Now how are we supposed to correct it? We are supposed to correct it by first giving Bimal his share of bonus. So his bonus is 30,000. So Bimal's account gets a credit for it, bonus. The balance left in profit and loss for that year is 1,20,000, which is distributed amongst the partners in the profit sharing ratio 1:1:1. And mind you, it was to take effect from the 1st of April 23. Now, the further adjustments which were there, building was appreciated by 30,000, fixtures written off, so it's a loss, inventories written off, so it's a loss on revaluation, and doubtful debts, the debtors are reducing, trade receivables are reducing, so again it's a loss. So on revaluation, the loss works out to 24,750, and this is debited to the partner's capital account in the new profit sharing. I'm sorry to say that, but it's in the new profit sharing ratio 1:1:1, because we are supposed to give that effect. Then, after we have recorded the loss and recorded the profit and loss adjustment account, we now need to take up goodwill valuation, because the retiring partner is to be given his share of goodwill. And they say that goodwill of the firm was given for the 4 years profits average multiplied by 3 because 3 years purchase. We get the goodwill coming to the total profits, total goodwill coming to 3,97,500 for the firm. But we want share of Amal who's retiring. So we divide it by 3 multiplied by 1. So Amal's share of goodwill works out to 1,32,500, which is credited to his account. We now close the capital accounts of the partners. First we close Amal's account, and the balance payable to him is transferred to his loan account because he retires from the business. And this will be shown in the balance sheet as Amal's loan account, 4,89,250. The other two partners, Bimal and Kamal, their capital balances will be brought down, 3,41,750 for Bimal and Kamal, 1,86,750. That works out to 5,28,500. And I have prepared the balance sheet for you so that you have an understanding as to where does that goodwill come. Goodwill is shown in the balance sheet, 1,32,500. That means that was a debit effect, and you have given Amal a credit of 1,32,500. So the balance sheet is prepared for your understanding.